Welcome again. Thank you for watching. Give us your time already. Subscribe if you didn't do so already. We talk every week for years. We talk about stock market. Sometimes we talk about bonds. Sometimes we talk about other products. Normally we talk about sectors, but today we're going to talk about another product. And why? Because stock markets, almost all stock markets are on the all-time high. Today it's Thursday. This afternoon the ECB came with an
rate cut.
25 basis points.
0.25%.
And that's the first time since 2019, and it was expected. That's why the market went up already. And we talk with investors the whole day, and we know that every investor that has a portfolio with stocks is struggling when I made so much profit on this share, I made so much profit on this share. Shall I sell it now? So a lot of people, because it's so high, have the same doubts at this moment.
Yeah, absolutely.
That's why we said, okay, today we do something different. Today we're going to explain you an example. It's one example. You have a lot of different examples that you can do about options. And options are high-risk products.
Yeah.
High risk because if you don't use them right, they are high risk.
Yeah.
I think we will give an example that if you use it in this combination, it's lower risk than having only the stock.
Absolutely. Without a doubt.
Yeah. So we can't explain. We have courses about options for hours. And we can talk with you for hours about options. And now we only talk in 10 minutes. We give you one example. So please, if you think that you like this kind of strategy, do your homework or reach out to us and we help you. And there are a lot of different possibilities that you can do on those shares. So Martin chose a share and I chose a share.
Yeah.
And then we explain the same example with another underlying.
Different,
Martin
and
starts.
also a different approach.
Yes.
Yeah. So presume that you own stocks of Amazon in your portfolio, and you bought them maybe last year somewhere around 130, 140. Well, at the moment they're trading at 182. So that means that only for this year, since January, Amazon has a return of 26%. 26%, and presuming that you bought them last year, you might be even on a better result. Now, I think as an investor, you should always be critical. What is normal? You stepped into a position, and I know for a fact that people buy stocks and they don't really think about, okay, 20% is enough for me. There's a very few people that do that. You just buy it, and if it keeps going up, and then at a certain point, well, it's okay, I'm going to sell it. But you have to force yourself to think in a strategy, think in a vision when I'm going to sell these stocks. If it's 20%, that's fine for me.
And this helps.
And this helps. It forces you to think in a strategy, and you can translate it into your vision into this specific strategy. And also, if you look at Amazon, there's an antitrust probe starting against large AI companies. On the other hand, the price target still lies above 200. But you bought them last year, and the price at the moment is 182, 26% plus for 2024. What could you do? You could say, okay, I'm going to place a limit order to sell them at 195, but you don't know if they will go there. On the other hand, you could also say, I'm going to sell a call option. And when you sell a call option, when you sell something, you have to do something for it. A service, deliver something, but if you don't say, you always have to do something. You don't get money for nothing. That sometimes happens when you win the lottery, but not with normal trading. So when you sell a call option, you sell somebody the right to buy your shares. You have to deliver them. You have to deliver them for a higher price. So what I looked at was a call option on Amazon for September of this year at an expiry, so September, the third Friday of September, at a strike price of 195. Well, what is a strike price? A strike price means that it's the price that you will have to sell those shares for if the stock, in this case Amazon, is at or above that price. So in this case, at or above 195. In return for me selling that contract, I get $7.20 directly cash in my account.
Per share.
Per share. So I get $720 in my trading account. That money, of course, is stuck to the obligation to sell my shares. When do I have to sell my shares? Not if they're below 195, because the guy that paid me, or the person that paid me on the other side, the premium is only going to buy my shares if Amazon is trading above that 195. If it's below, then he will buy the stocks in the market cheaper, of course. That's logic. So that money, $720, is mine. I keep it until I want, basically, unless I buy the option back, but we don't go there today. 720 you get. But on the other hand, you're also not really sure about the market, the interest rate hikes, whatever, and you want to protect yourself. You want to buy an insurance. Insurances are always expensive. But as you receive the premium, you could basically lock in the profit by buying a put option. And a put option, the word says it like itself, you can put down your shares. If you buy a put option, you pay premium, you pay insurance premium, and you have the right to sell your shares always for a certain price. And I looked in this case at the put September 175. And the put 175 allows me, if I buy it, if I pay the premium, to always sell my shares, even if Amazon dropped all the way down to 70, to sell them for 175. Well, that's for me convenient, and I sleep really easy at night. So if something happens, I can push the button and sell my shares. So I think this is really something to consider. Markets at all-time highs, sell a call option for premium and to finance some insurance. One of the safest way of investing, we can say that, no?
Mm-hmm.
Because there's nothing safer. You can't buy a house and buy an insurance that you could always sell it for the same price. Here you can say, I own stock and I want to write that I can always sell them for the price that I want. And of course it has a price, and that price you pay out of call premium. So that was my example with Amazon. What do you think about it?
I think it's great because I have the same example.
Great.
But on another company, that I think it always works if you see two different underlyings with two different
approaches.
Numbers.
Also, yeah.
I talked about Besi and Besi Semiconductors. The world says, okay, they are in the semiconductor industry. NVIDIA, for example, is a client of them. Are they also performing like NVIDIA, 150% plus this year? No, they are not. The highest point was having 170 euros. The lowest point was something around 130. I don't know exactly. And they're now trading at 145 euros. If you look back for a long time, then the 170 was the highest price ever. So, and they are still close, relatively close to the highest level. So again, if you think, I'm not sure, it's high, it's not the all-time high, but I don't want to take the risk that I lose a lot on it. Then and in my case, I start with buying the put. So I start buying the insurance. For example, also September, so the same time frame as Martin said, you buy the 130 put. That means that you can always sell the shares until September for 130 euros. So that's still a loss of 10%, but you can't lose more than 10%. That premium, because you buy the put, you have to pay a premium, and you pay around €6.50 for it. So you have to pay the premium, but you can't lose more than 10%, 145 to 130. You can always sell it for 130. Again, I'm going to sell a call option. I get a premium, and I choose the same difference between the 145 and the 30. So I go to the 160. I can always sell it I have to sell it for 160. So I can have a maximum profit of 10%. But I get a premium for it because I sell the call option. In this case, I receive around €7.50. So I have €1 extra. But I know I can't lose more than 10%. It's until September. And some people say, okay, I want to lock it in for a longer time frame, for December this year, or maybe for a couple of years. You can do that also. But then you can't. The downside, because everything has a downside, you cannot earn more than 10%. But I think, especially on your example, where you already made 26%, if you have it from the beginning of the year, if you then lock in an extra percentage of profit, in my case 10%, 10% from now in a couple of months, it's fine, I think. And you can't lose more than 10%. So you don't have to do anything. And if it stays 145, you don't lose anything.
Yeah.
But this can be a good example, when prices are high, you don't want to sell it. If you want to sell it, just sell the share. But if you don't want to sell it, and you're doubting, and you want to lock your profits in, that's important. So in this case, you cannot lose more than 10% because you finance it with selling the call option. And then you can sleep easily, and you can watch whenever you want. And maximum risk, 10% in this case. Again, options, difficult products, complex products, do your homework. Don't replicate what we are saying, but we want to give you an idea what you can do in this case. With a high
and
price.
if you want to know, if you own a stock and you have this idea, different months, different weeks, different days, you can even do this daily.
But I hope that the people that watch the video, they see that if you do this, okay, you have a maximum profit, but you have less risk.
Absolutely.
Because you have only 10% downside risk in a couple of months.
Yeah, and
so it's less risk than having the share, but the share can go to zero or can lose 30%. So if you use it in the right way, it's less risk.
Absolutely.
And that's what we all want, less risk in life.
Sometimes, yeah. Thank you for watching.
Dit was je Tom.
We'll see you next week.
Thank you. Bye-bye.